What are options? As I mentioned in the story of the Lees from Miletus, options are derivatives because they get their value from an underlying asset. It's a financial derivative that gives the holder the right, but not the obligation, to either buy or sell a fixed amount of a security or financial asset at an agreed upon price on or before a specified date. And this is in regards to American options. As I mentioned before, Black-Scholes came up with a pricing model. Well, that really specifically deals with European options, where you can only exercise at a specific time, which is at the very end of the options term. With American options, we can trade these and exercise our right to receive the stock or the underlying asset at any time in the case of buying a call, and in the case of buying a put, to sell our underlying security to the individual who is the writer of that option. What are options? Well, with a buyer, options give the buyer the right but not the obligation to buy the underlying asset with a call and sell the underlying asset with a put at a specified price, which is what I just went over. Well, the seller incurs the obligation to fulfill the transaction if so requested by the buyers in the option, and can usually be sold from the original buyer to a third party. What does that segment mean? Well, it just means that there's a market out there that if you were to buy the option, you could sell it on the open market rather than to exercise that option or take possession of the underlying asset. In return for granting the option, called writing, which means the seller of the option, the originator of the option collects payment, the premium, from the buyer. So the premise of this is that if I am going to take this risk with you, I need to collect something in return. It's all about risk and reward, right? So if I'm going to pay something, I need to have a bit of a guarantee, and if I'm going to sell something, I need something to cover a little bit of my risk. The writer of the option must make good on delivering, called from you is a way to remember this, or receiving, put to you, in regards to the underlying asset or its cash equivalent if the option is exercised. So as the writer, I'm selling this, so I have to deliver the stock if in the case of a call. And as a put seller, I must take the asset from the person. So if the person bought a put on gold, I would have to take their gold at a higher price than what the strike was. So now we're going to be getting into a little bit of the terminology. Before we did the definitions and the history, now we're going to be talking about options basics.